Cost Concepts Problem Solver. Hello all. During class we discuss concepts and work drills. This video is designed to provide additional insights for the material covered while developing your problem solving skills. The expectation is that you understand the concepts prior to solving problems. You must understand what you're doing before you can start number crunching. Viewing the concept videos and reading the chapters will ensure your understanding of the concepts. For these problem-solving videos, the Excel illustrations presented can be found in the chapter modules on Canvas. Let's look at a comprehensive problem focused on understanding the basic cost concepts. Remember, always get familiar with the information provided by carefully reading the problem. Only after understanding the question can you begin crunching numbers. Data provided by the SAM Corp is listed on a per unit basis as well as a per period basis. Direct material, direct labor, and variable manufacturing overhead are all variable costs and as such are listed on an average cost per unit basis. The fixed manufacturing overhead is the cost for the entire period. Direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead are all product costs, which means that they will be carried on the company's books as inventory until the finished product is sold. Sales commissions and variable administrative expenses are variable selling general administrative expenses, and as such are listed on an average cost per unit basis. Selling general and administrative expenses will be referred to as SG&A as we move forward. The fixed selling and administrative expense represents the cost for the entire period. As you know, SG&A costs are all period costs, which means that they are expensed when incurred and are reported on the income statement. The information provided also shows the units produced and sold, as well as the selling price per unit. The assumption made is that the company is operating within the relevant range, which means that the variable cost per unit and the fixed cost per period is valid for all questions relating to the data. The key to solving problems in this class is to read the question and then follow some strategy like Bucks to do the solution. B stands for box the question. You want to make sure you know what you're being asked to solve. U stands for underline the concepts. Here too, you want to know the concepts that you're dealing with. C stands for check off the relevant data, while K stands for knock out the irrelevant information. And then finally, S stands for solving the problem. Questions A through K are based on the data provided in the schedule. Boxing each question is simple, as a problem to be solved for each case is simply stated. Question A asks that we determine the total amount of direct manufacturing cost. The concept to be underlined here is direct manufacturing cost. As you know, these costs are easily and conveniently traced to a specified cost object. The cost object for this problem is the product being produced and sold. The relevant data includes the 5,000 units produced, the direct materials cost at $6 per unit, and the direct labor cost at $3 per unit. The total average cost per unit will be $9, the $6 plus the $3. Data related to indirect costs and selling price are irrelevant to this problem. We can now solve the problem. Since 5,000 units were produced, we multiply the $9 by 5,000 units to get the total direct manufacturing cost of $45,000. Question B asks that we determine the total indirect manufacturing costs incurred. The concept to be underlined is indirect manufacturing costs. These costs are related to the manufacturing process and are incurred for the benefit of more than one cost object or are costs which cannot be easily or efficiently traced to a specific cost object. Indirect manufacturing costs are referred to as manufacturing overhead and include indirect materials, indirect labor, and factory operations. The relevant data includes variable manufacturing overhead of $1 per unit, fixed manufacturing overhead of $15,000 per period, and the 5,000 units produced. Any costs related to direct materials, direct labor, SG&A, and selling price are irrelevant. Since indirect manufacturing costs are a mixed cost, we need to determine the variable manufacturing overhead and add it to the fixed manufacturing overhead. Variable manufacturing overhead is $1 per unit times the 5,000 units produced for a total of $5,000. Fixed manufacturing overhead is $15,000 for the entire period. Solving the problem requires that we add variable manufacturing overhead of $5,000 to the fixed manufacturing overhead of $15,000 to get a total of $20,000. Question C asks us to determine total product costs. The concept to be underlined is total product costs. Total product cost is the sum of direct material, direct labor, and manufacturing overhead. To get the total cost of each, we multiply the per unit amount by the units produced. The relevant data includes the direct material of $6 per unit times 5,000 units produced, or $30,000. Direct labor of $3 per unit times 5,000 units produced, or $15,000. And the manufacturing overhead totaling $20,000. Because manufacturing overhead is a mixed cost, it includes the variable portion of $1 times 5,000 units for $5,000, plus the fixed cost component of $15,000. All other data is irrelevant. The problem is solved by adding the four amounts for a total of $65,000. For this problem, the amount produced equals the amount sold. Had there been a difference between those numbers, we would have multiplied the per unit costs by the units produced and then added the fixed cost to determine the total product cost. Question D asks that we determine total period costs incurred. The concept period cost refers to costs which are necessary to run the business during this specified period. Period costs include all SG&A costs. Period costs are not included as part of the cost of either purchased or manufactured goods. Instead, period costs are expensed on the income statement in the period that they are incurred. For this problem, period costs include sales commission, variable administrative expenses, and fixed SG&A. All other amounts are irrelevant. Since sales commission and variable administrative expenses are variable, we need to multiply the average per unit costs by the amount sold. In this case, sales commissions is $1.50 times 5,000 units sold, or $7,500. while variable administrative expenses is 50 cents times 5,000 units sold, or $2,500. For this problem, the amount produced equals the amount sold. Had there been a difference, we would always multiply the per unit cost by the units sold, since we're determining the SG&A. To solve the problem, we add the total variable cost of $10,000 to the fixed SG&A for the period of $5,000 to get a total period cost of $15,000. Question E asks that we determine total variable cost per unit. The concept here is total variable cost per unit. The per unit amounts for both variable manufacturing cost and variable SG&A are relevant. The selling price and fixed costs are irrelevant. Summing the direct materials cost of $6 per unit, the direct labor cost per unit of $3 per unit, variable manufacturing overhead of $1 per unit, sales commissions of $1.50 per unit, and variable administrative expense of 50 cents per unit gives us total variable cost per unit of $12. Question F asks that we determine the total variable costs. Well, since we already know the variable cost per unit is $12, we simply multiply the $12 by the 5,000 units sold to get $60,000. Question G asks that we determine the contribution margin per unit. The contribution margin is a key term for this class. It's the amount remaining from sales revenues after all variable expenses have been deducted. This amount contributes towards covering fixed expenses and then towards the profitability for the period. When discussing contribution margin, we can talk of it in terms of a total dollar amount, or a per unit amount, or as a percentage. The percentage is called the contribution margin ratio. Since the focus for this question is contribution margin per unit, the relevant data includes the selling price per unit and the average per unit data for all variable costs. All fixed costs are irrelevant. To solve, we total the variable product cost of $10 and the variable SG&A cost of $2 to get a total variable cost of $12 and subtract the amount from the selling price of $20 to get a contribution margin per unit of $8. Question H asks that we compute the net operating income. Determining net operating income starts with sales. From sales, we subtract all variable costs, both variable product costs and variable SG&A costs. Sales minus variable costs equals contribution margin. From the contribution margin, we subtract all fixed costs, both fixed manufacturing overhead and fixed SG&A. The remaining amount will represent a net operating income, or NOI, or a net operating loss. Sales is determined by multiplying the selling price of $20 per unit by 5,000 units to get $100,000. Total variable cost is $60,000 as we calculated earlier. It includes variable product costs of $50,000 and variable SG&A costs of $10,000. The contribution margin is the difference between sales and total variable cost, or $100,000 minus $60,000. The contribution margin totals $40,000. And remember, this represents the amount to be used toward covering fixed expenses and then towards profits for the period. Total fixed costs are $20,000, representing $15,000 of fixed manufacturing overhead and $5,000 of fixed SG&A. Subtracting the total fixed cost from the contribution margin gives us a net operating income, or NOI, of $20,000. You should note that you could have determined the NOI quickly by multiplying the contribution margin per unit of $8 by the 5,000 units sold to get a contribution margin of $40,000, and then subtracting fixed costs of $20,000 to get an NOI of $20,000. Question I asks for the incremental change in manufacturing costs if production increases by 1 unit. The concept of incremental change refers to the additional costs incurred from producing the additional unit. The only data relevant to this problem is the total variable manufacturing cost per unit. Everything else is irrelevant. The answer is $10. The reason being is that since we are remaining within our relevant range, the fixed costs in total and the variable cost per unit will not change. The only change to occur will involve the variable manufacturing cost total. The amount will be $10 times 1 unit, or $10. If we produced 100 more units, the incremental change would be 100 times $10, or $1,000. If we produced 200 more units, the incremental cost would change by 200 times $10, or $2,000. In all cases, the incremental change will be the additional units produced multiplied by the total manufacturing cost per unit. Question J asks that we determine the contribution margin ratio and use it to determine the net operating income. The concept here is contribution margin ratio. The contribution margin ratio is determined by dividing the contribution margin by sales. The answer will always be a percentage. We can either divide contribution margin per unit by selling price or the contribution margin total by total sales dollars. Either equation works. For our case, the contribution margin ratio is 40% and is determined by either dividing $8 by $20 or $40,000 by $100,000. Once the 40% is known, it can be used to quickly determine the net operating income. We multiply the contribution margin ratio percentage by the dollar sales and subtract the fixed costs. So 40% times $100,000 in sales gives us a $40,000 contribution margin. Subtracting $20,000 of fixed costs gives us a $20,000 net operating income. Question K asks that we calculate both prime costs and conversion costs. Prime costs is made up of direct materials and direct labor. It gets its name because these two costs are what is needed to start production. For this problem, the cost per unit for direct materials was $6. Multiplied by 5,000 units produced gives us $30,000 for direct materials. The cost per unit for direct labor was $3. At 5,000 units produced gives us a total of $15,000 for direct labor. The total of direct material and direct labor is $45,000. So our prime cost is $45,000. Conversion cost is made up of direct labor and manufacturing overhead. It gets its name because these two costs are needed to convert materials into finished product. For this problem, direct labor is $15,000 as previously calculated, while manufacturing overhead is the total of variable manufacturing overhead and fixed manufacturing overhead. Variable manufacturing overhead is $1 times 5,000 units produced, or $5,000, while fixed manufacturing overhead is $15,000 for the entire period. The total manufacturing overhead then is $5,000 plus $15,000, or $20,000. The sum of direct labor of $15,000 and the $20,000 of manufacturing overhead gives us $35,000. So our conversion cost is $35,000. Lots of calculations here, but this comprehensive problem covers most cost concepts which will be used throughout the class. Bucks was used throughout the problem to illustrate the value of having a problem-solving strategy. If Bucks doesn't work for you, I encourage you to take time and develop something else. As we move forward, I will move a lot quicker. I use this problem to introduce you to the problem-solving process. The Excel template for this problem can be found on Canvas in Module 1, labeled PS1-Cost Concepts. Thanks for viewing this video. Good luck.